Anyone who says macro is not important, I always challenge that. I think every day you wake up and there's macro analysis going on through markets. Yes, over long term, there's no doubt that economies and the world economy will grow. So if you're a very long-term investor, short-term macro is not really significant to you. But at our ages, we can't be thinking 20 and 30 years out. We've got to be thinking 1, 2, 3 years. We've got to set our portfolios appropriately, our asset allocation appropriately, and understand where the returns are going to come and if they're going to be challenged by what's going on around the world. But there's no doubt, I think we are going through some sort of bubble cycle. Maybe it's an inflation cycle of some sort, asset inflation cycle, but it's the same thing. Prices are very elevated against historical norms. And there's a whole lot of measures there. I'll just pick on the third one. There is an old rule of 20, which I think I've talked endlessly about for many, many years. It's what I learnt in the 80s. Effectively, the inflation rate or the bond yield plus the PE should equal 20. Well, when you've got PEs around the world over 20, it's very hard to get the rule of 20 to work. In America today, the stock market's trading at around 27 times on average. It is weighted high because of some stocks. The bond market, the 10-year bond, is sitting around 4%. So we've got a rule of 20 trading at 30. So that should immediately suggest that we have got excesses in the marketplace. There's always an argument that the American market is different to the rest of the world because of its unique growth, its entrepreneurial spirit. You can talk about its president, but certainly it gets on and does stuff. And it is the IT generator driver of the world economy. So built very big multinational companies which trade off the whole world's growth and supply the world with intellectual property. The other big issue in terms of what's driven the world's growth, particularly in the last 15 years since the GFC, has been the absolute amazing growth in government debt. Just last night I read an article coming down the plane. America's government gross debt tipped through $38 trillion last night. And the analysis of that is that there's obviously a lot of debt being rolled in America. The American Federal Reserve has said that they're going to stop reducing their ownership of government bonds. So they're going to go, that's called QT. They had a QE program coming out of COVID. They switched to QT where they just let the bonds mature. Now they're going to reinvest all proceeds from bond maturities. Concurrently, as bonds are rolling in America, 80% of those bonds are being issued with less than 12 months maturity. So there's a massive increase in short-term government debt appearing in America. Now, maybe they know something we don't know. Maybe that's a forerunner to the driving down a long-term bond yield. So they don't want to issue long-term bonds because they expect long-term bond yields to come down. How could they be so confident? Well, there's only way you could be confident if you know you're going to go into a quantitative easing program where money is printed and bond yields are manipulated down, long-term bond yields. That's one of the views which I have. It's in your letter to investors. That's where I think we're going in 2026. It's not a new view of mine. I've been saying it for at least 18 months because I can't see any way out for the American government debt situation than a significant quantitative easing program. And significant, it'll be the biggest ever. Okay, it'll dwarf anything. Now, is that good or bad news? Well, first of all, it says that the Federal Reserve is aware of the problem, but it also suggests that markets can be pushed higher. However, if it's obvious to me, it's obvious to the market. And what's the market? The market is full of massive trading entities, and if they think a QE is going to come in 2026, they're not going to wait to 2026 to move asset prices. They'll run ahead of it. So you get this major front-running rally. Now, time will tell whether that's the rally we saw this year, over the last 12 months or 2 years, that rally, certainly ex-Trump, that rally is a precursor to printing of money. But when the printing of money occurs, don't be surprised if the markets do nothing because it's fully priced in. Okay, so I've taken you on that little journey. So if we go through the dot points here, we believe that the US Federal Reserve, the Central Bank of America, will adopt a QE policy. The first part of that's underway, so it goes from a quantitative tightening to just a balanced reinvestment of proceeds of bond maturities and interest back into the market. They're also saying that they own about $2 trillion. Goes way back to the GFC of mortgages. Remember, the Federal Reserve bought a lot of mortgages off, was it Fannie Mae and Freddie Mac? It wants to release that final $2 trillion in the next few years. That'll be an interesting sell down. Now, quantitative easing will act to push interest rates down. At the short end, that's cash management. At the longer end, that's quantitative easing. That's purchasing bonds across the maturity curve. The maturity curve of America is sort of stuck at present. It tried to rally, and I always look at the 10-year bond and the 30-year bonds. The 10-year bond's important as a risk-free rate of return. The 30-year for mortgages in America, that's what it's priced off. Nothing much has been happening in the last 3 months. We had a bit of a stir-up after the Trump trade, but then markets rallied on, America's going to come through this and a bit of a flight to quality, and now it's backed up somewhat. So the equity market's not being supported by a rally in bonds under its own weight. So if the bond market is the most open market in the world, there is no confidence in the bond market that inflation is under control in America, certainly since the introduction of tariffs. So we're working through that process. So the puncher, the bond yield down, get that risk-free rate of return down, is going to need interference by the Central Bank of America. That amounts to manipulation of the risk-free rate of return. Manipulation of the bond yields started, as you know, in the late 1990s in Japan, and they haven't stopped for 26 years. Europe particularly went hard 2009, and America joined in 2010. There's been at least 3 QE policies in America, so we'll probably see QE4 shortly. That creates liquidity in the marketplace. Not that we don't have enough liquidity already. There's way too much capital flowing around the world looking for someone to invest, and it's not really investing, it's trading. It's just trading the markets. Front-running policy, front-running QE, front-running interest rate adjustments, moving currencies, front-running Trump's announcements, but maybe that's insider, I don't know. So a lot of front-running by massive hedge funds, okay? And very much the prices of assets today don't reflect anything other than sentiment. They don't actually reflect true value, okay, as measured by intrinsic value, return on equity, yields of stocks, cash flow. They just trade. And that's something we should be aware of, okay? So it looks exciting when prices go up, but if it's not a fundamental basis, then we should not be so excited. Now, there's certainly a political issue around the world. Congratulations to our government. He was one of the only Western governments to survive an election. Everyone else had a protest vote against him, so he goes to the G20. He looks like a hero. No one can understand how he survived. And I don't think he thought he was going to survive until 3 weeks before, but I don't want to get into politics. But there is a significant protest vote by the next generation. And you can see it coming through in recent polls if you read the papers, apart from the fact that no one knows who the Liberal Party is, and they somehow know who Pauline Hanson is, even though she wants to retire, there is a significant protest vote from the 18-year-old voters, and yes, they can vote, all the way up to 30. And then they'll just vote against the government, whoever it is. They don't care. And it's gone right across Europe. It's going through England. So what happens then is that the incumbents come up with populist policies to buy votes. They'll do anything to buy those young people's votes. And they don't care about you in this room. You're too old. Okay? And we've got to be aware of that. And you can see it coming through. There is very little concern for you in this room who are looking after yourself in retirement. And then Australia has this unique housing crisis. No one wants to say it's an almighty bubble. We've made housing unaffordable. No wonder the next generation is so pissed off. Just think about if you came out of school, had a young family, and you were 25, and you couldn't afford to buy a house 40, 50, 60 years ago. You would have been screaming about it. I'll get back to that in some of our charts and slides. Okay, so the equity bubble. So I talked about that. This is an interesting chart. It just says that the world now is running well above whatever its long-term average is. The world index is about 24.7. The American index, at the time this was taken, was sitting around 26 times. And clearly the most expensive market in the world outside India. Now, you can justify India because its GDP growth is 7 or 8% compounding, and it looks like it's going to grow at that rate for the next 30 or 40 years. So you can put a premium on somewhere like India, but the premium on the American stock market has obviously got issues around it. When we go to yields, sorry, before I get off the PEs, you can see where the Australian market was pre this recent correction. And this recent correction has pulled down the Australian PE from that elevated level. And that's what you want to see. You know, I know it's painful, but you want to see markets come back to more rational pricing, because if they don't, they're susceptible to a sharp correction. On the dividend yield side, there's a couple of interesting things. The world index is well below 2%, as you can see. So there's not much joy. And if inflation's running at 3, you're not really getting a dividend yield to match inflation. So you're looking for dividend growth to compensate for inflation. That's why we buy stocks. But 1.8, so a long way below the inflation rate of 3% around the world. The American index yield is very, very low at 1.5%, so it's gapped down as the P is expanded. Australia still represents a reasonable yield market, but nowhere near its historic levels. And this is becoming an issue in terms of generating income out of the stock market. The Australian stock market, 3.2% yield, 70% franked. You know, not a lot of joy there. We can remember not too long ago we were seeing 4%, 4.5% yields. So we've lost that yield benefit. Right down the bottom we're seeing Saudi Arabia, and I'll get back to Saudi Arabia shortly. And it's interesting economy, as it's used its unfair advantage in the cost of energy to drive a restructure of its own economy, and it's being rewarded with in capital inflows into that market and giving a reasonable return. Okay, so when we look at headwinds and tailwinds, which is what I always try to do, so what are the positives? There doesn't appear to be a likelihood of a worldwide recession in 2026. In fact, you can bet your bottom dollar on the fact that central banks will do their darndest to make sure there's no recession through monetary policy, quantitative easing, cutting interest rates. And then you've got the governments, who should be trying to balance their budget. They have no interest in balancing their budget. There are no votes in balancing a budget. So I would warn both political parties to stop saying we are responsible fiscal managers. There's no votes in being a responsible fiscal manager. In fact, most of the people don't even know what responsible fiscal management is. Okay, so there's no votes there. The yield curve will be compressed down through QE, so that goes from cash all the way out to 30 years. That's the likely policy in America. The question mark will be whether Australia follows it. Europe is dragging itself along, and there's a lot of upheaval looking at the overseas news in Europe. UK is in and out of recession. Very, very low growth rates now in Germany again. And they're getting bombarded by China exports into their manufacturing base. So one of the things Trump has done is stir up China, and China, as it's reset its export focus away from America, is hitting the European markets. And we know the Europeans don't want to put tariffs on China. So there's a slow growth cycle occurring in Europe, and it may get worse before it gets better. China has a lot of firepower to redirect its economy, or to stimulate its economy. I think it's much more controlled now, growth. 5% long past, we're probably talking 3 to 4% type of growth, very, very focused. They know they've got an issue in the property market. They're letting that bubble deflate. Maybe the rest of the world should look how you deflate a property market. Very hard in Western society. But they will do what they have to do to sustain that growth. And clearly they're going to support exporters away from the American economy. It's already happening. And you're seeing complaints coming out of Europe that these manufactured exports are going into the European market, and the Europeans are complaining that this is with trade support from the Chinese government. India looks like a 20-year growth cycle. India, as you know, is part of BRICS. That's interesting. It's not in the G7, so to speak. It's in the BRICS. I don't know why it's not in the G7. It's a pretty big economy. It's growing fast. But they've had a bit of a kerfuffle with America, as you know. They were buying Russian oil. I think it was correct for Trump to say to them, that's not a good thing to do. I don't want to sound like Trump, but it's not a nice thing to do. And so they've seemed to have relented under the pressure of tariffs to stop doing that. So that's some good news there. So India will play the whole world. They'll play the BRICS and they'll play the G7, the G20. They'll do whatever is needed to sustain their growth. Seem to be a fairly well-managed economy. Japan is living proof that QE can divert a financial calamity, but what do you get? You get 25 years of nothing, and then all of a sudden markets rocket. So we've just got to be careful about what QE creates. Does it create prices which are so high they can't go anywhere? Does it compress economies? Does it make credit so cheap no one wants to borrow it, no one wants to lend it? It's something we have to understand. But Japan is still with us. They didn't implode, despite the fact that they've got about $10 trillion US of debt on an economy which is $4.5 trillion. And then we've got Australia, which when you look at it from afar, looking back, and it's very hard for us to do in this room, but I think you're reading the tea leaves, is that we have a real crisis in productivity, a real crisis, and our productivity has collapsed. And in the past, I've talked to you about why I thought the Australian dollar was undervalued. Now I think it's becoming quite obvious that it's fairly valued based on our productivity, which is scary, because we're running a reasonable budget. We don't have a lot of government debt. We have a current account surplus. We have a trade surplus. In economics, that should be positive for the Aussie dollar, but it's not. There's something else going on. It's our lack of productivity. And it's really bad at present. No more driven by the government sector. Okay, the negatives. So what are the headwinds? We still have a core US budget of $1.5 trillion. Like they've shut down the government. It's just opened up again last week, so they probably saved $100 billion there on doing that for a month. Who knows? But we have a core deficit of $1.5 trillion, and I might even be understating that. If interest rates stay at 4% and they've got $38 trillion of debt, do your own maths, you're talking about a $1.5 trillion interest bill, so before you get to the underlying deficit. So I might be a bit light on that. So that's why QE is urgent. US debt's growing faster than the GDP, and that's potentially adds up to a disaster. It's all right to grow debt, but you want your gross domestic product to grow faster than that debt load. It's very important. Now, America sustained itself with very strong growth post-COVID. We're talking gross growth, so adding back inflation, 5-6% compound. Very, very fast growth. That's why the economy rocketed from circa 20 trillion to over 30 trillion in 4 or 5 years. So it's very, very significant. But it's a bit like Australia. A lot of it was inflation. The Australian economy grew rapidly from COVID to now. We grew our economy by $800 billion in 4 or 5 years. I didn't see it. It was all in the inflation numbers. Europe is challenged by what I said earlier, China, but obviously ageing demographics, and very much populism. The political leaders there just don't know what to do to get their votes. It's becoming a mess, as you know, in France. And I think there's more challenges coming in the United Kingdom. China is growing, but per capita growth is lower than the actual gross growth. So they are hitting their first sort of bump. They can't afford to lift wages in the world today, given the tariff issues. That's one thing Trump's done, is slow their ability to increase wages, and they're going for a restructure of their industrial base. And we are seeing a jump in youth unemployment in China, which we have to watch, because that's a big issue over there if 100 million people can't find a job. I've talked about India's relationship with the BRICS. They're playing a very good two-sided game. Japan demographics are well known, declining population, but again, their stock market is near all-time highs and goes up and down 10% every month. They're still with us. And then we've got the transition of Australian energy, which I don't want to go into great detail, but it is diabolical. It's diabolical that we can't, as a nation, agree on a clear strategy, which doesn't matter who the government is, it's just adopted. Why are we debating it? Why aren't we using our natural resources to our benefit, not only for our cost of energy, but in terms of our industrial base, or developing an industrial base which doesn't exist? So the themes for 2026, the introduction of QE to drive down interest rates, to make the servicing of debt by the American government manageable. I use the word barely manageable as opposed to manageable. The AI cycle, it's obviously sucked in a lot of capital. It's driven a lot of valuations in the American stock market. Are they sustainable? Well, guess what? Time will tell. It is an issue. A lot of money's being made, but maybe it's being made and you need to sell it to really make sure you make that money before there is a reality cycle where all of a sudden stocks are valued based on fundamentals as opposed to potential. There's certainly a productivity lift coming in America. We're seeing it already. We're seeing an improvement in operating margins across a lot of IT companies in America, so there's no doubt it's working in some respects, but it's also going to challenge a lot of companies who don't adopt it or who are forced out of markets because they're being replaced by AI-driven other companies. Where's the US dollar go? So it's been quite weak since Trump, but you wouldn't know it in Australia. But on a world index, the US dollar declined about 10%, ex the tariffs. Australia rallied, as you know, and now we're giving it all up again. So we're half as weak as the US dollar. Energy demand transition, still working through. I think we're seeing the die set in the major Western economies. They are moving more to nuclear. Yes, they are decarbonising, but they're doing it with nuclear. And that's a real issue for Australia given our immense supply of uranium. Tariff responses, I think we've gone through the worst here. I think we're seeing that the dust is settling pretty quickly. Trump's been very quiet recently, and maybe there's other reasons going on, I don't know, but he seems to have done everything he wanted to do. And he's now seeing the results of his ploy that China is pivoting and quite aggressively and quite successfully in finding other markets. Now, you might have read overnight, for instance, that the upshot of the recent discussion with India and America, or US, was the tariffs on beef. So China's maintained its 50% tariff on American beef, so we're getting a huge demand out of Australia. And then America put its 50% tariff on Brazil, and they're buying Australian beef as well. So we're running about a $4 billion per annum beef export market. No effect on us. In fact, it's beginning to grow again. So it's all having interesting consequences. And I honestly don't think the Trump administration actually understood how the markets would react to a major change which he implemented. So I said China's responding and pivoting, and the Australian productivity hole, which we'll go through. Now, quickly, some charts before we have a little break for morning tea, and the idea is to have me talking and then have a break, and then we come back and talk about specifically markets, debt and equity markets. Okay, here's the American deficit. Now, if you take out the COVID years, which obviously jump off the page at you, and you look at the cycle over the last 10 years, I don't think you can miss it. It's just going up. So it's gone from around $500 billion deficit heading towards $2 trillion. And it's unrelenting growth. And in that period, American government debt's exploded, the interest bill's increasing, they need to get interest bill down. But that's a pretty clear cycle. I can virtually put a line and say where it's going to be unless there's dramatic change in economic policy. There's the debt growth. Now, what we're seeing, and I want you to focus on this, we're seeing debt to GDP levels, the like of which we haven't seen since the Second World War. And unless I missed something, we're not in the Third World War. So the American economy, American government has a debt load the like of which it hasn't seen for 80 years, and the last time it saw it, it went through 4 or 5 years of war investment. So we have a very poorly structured economy when you overlay it with government debt, and it's unexplainable really by the economic cycle. In terms of issuing of debt, we have a lot of debt rolling. As I said, it's hit $38 trillion. I guess 4 to 5 trillion of that debt's rolling, sometimes more, per annum. So in terms of who bought the treasuries of America in 2024, now the leading buyer, or the residents of the Cayman Islands were the biggest buyers of American debt in 2024. Is anyone here from the Cayman Islands? Anyone? So it wasn't you. So the Cayman Islands, and I suspect that's hedge funds. Don't know, I've got this funny feeling there's hedge funds in Cayman Islands avoiding tax. Okay, so are they long-term investors in American debt? Absolutely not. They are front-running QE. Okay, they're also highly geared. So they're geared buying a highly geared economy's debt. That's interesting when you think about it. The one that jumped off the page to me, apart from that, was this country called Tether. Now, I went to Flight Centre recently and tried to say, can I go to Tether? Apparently it's a great place to visit. And no such place. I said, yeah, there must be a place, because Tether's been buying American bonds. And I thought, oh no, I fell for the trip. There isn't. Tether is a Bitcoin. What do you call it? A stable coin. So stablecoin issuer is the 7th largest buyer of American treasuries. Now, that could be exciting or that could be disturbing. Depends on where you're coming from. It doesn't look to me to be as stable as you would think. I'm playing on words there, so you can laugh at that one. Anyway. So who got rid of their bonds? Oh, India, Ireland, Brazil, Japan, China. So everyone who Trump annoyed or was going to annoy has been selling down their bonds. So if you're running a $38 trillion debt, I think you need all the credit friends you can get. Okay? So maybe this is the flip side to the Trump policy. He needs to look after his capital suppliers unless he's going to replace them with quantitative easing. Maybe he doesn't care. If he's going to go and print $10 or $20 trillion of money, maybe he doesn't care about foreign owners of bonds. Who knows? US economic growth has been spasmodic. We had a big downturn in the March quarter. That was really imports flowing into America prior to the tariffs, which were well flagged. So a lot of imports coming into an economy with negative growth. We had the tariffs, and then we had to bring in the exports and cut down the imports, so America had a surge. And America is stabilising at around 2% growth as we speak in the September quarter. So it's not great. Now, obviously, some of the numbers we're looking at today we haven't been able to update for a month because they've been on strike over there or closed down. But we suspect when they do get back to work, we will see a slight increase in unemployment, a slight increase in inflation, and it just won't be exciting. It'll just be probably the slowest cycle America's seen since COVID in terms of quarterly growth. Now, there's no doubt that the tariff changes did generate revenue growth. As you can see there, it looks like annualised, and it's really a GST, so it's a tax on consumers on imported goods. It looks like it bringing in around $300 billion more than pre-Trump tariffs, so we've had a significant benefit. But if that's a $300 billion benefit to the budget, it's unlikely to be held because you know that Trump's bringing in tax cuts for certain people, instant write-offs for capital investment for certainly companies which are going to replace imports. So the benefits to the budget of that will probably be gotten rid of or pushed away by other factors. So we don't see the American government deficit improving by $300 billion is the point there. I said that China is pivoting, and here's an example. So you can see a dramatic decline in China trade with America post-tariffs. So China has pivoted and tremendous growth everywhere else. So is that success for America? If they're trying to, and I think there's no doubt that this trade policy has a lot to do with America trying to slow the economic growth of China. I think it's very, very targeted. There is collateral damage around the place. You know, we were very lucky that we weren't caught in collateral damage. It could have got out of control because our biggest export partner is China. You know, if Trump was in one of his mad moments, he could have picked on us and said, why are you exporting iron ore to China? That would have been uncomfortable, but he didn't do it, thank God. And now he's buying our beef now, so that's quite exciting as well. But the world trade environment's changing dramatically, and the centrepiece is China. And quite frankly, I think they have been a great supporter of America's growth through exporting cheap componentry. So if America doesn't want that anymore, well, let's see how they go by themselves. It's going to take a long time for America to replace Chinese supply lines. And if they don't, they're going to pay the tariff. Now, is the China growth story stalling? I think it's slowing, and this chart suggests that there is no doubt that China is growing, so that's through the electricity generation side of the table. No one produces electricity to go nowhere. Although apparently we do in Australia with solar, but that's another comment. I didn't say that. But there's no doubt that China is growing if you judge it based on electricity generation. But flip to the other side and look at steel. And there's an interesting development here which we have to note, you know, and this probably goes back to BHP and Rio and Fortescue in particular. Steel production, or steel products and crude steel. So there's no doubt that crude steel, which is your blue, has begun to stall. Why would that be so while steel products is growing? And what's happening after 20 or 30 years of industrial development, is that we are seeing the development of recycled steel in China. So once an economy goes through the primary build cycle, it then gets into a more mature industrial cycle, and steel recycling comes into play. So we're seeing steel production go up, probably the increase of recycling. Now, Australia supplies primary because we provide iron ore into the primary production of steel. So it's unlikely that the iron ore price is going to rally from here. Okay, I think the game for China is over for Australian exporters. However, there's still India coming in behind it, and how we engage there will be interesting to watch. Now, getting on the Australian economy, what is the rest of the world seeing from the outside, and why are they pushing us down in terms of our currency? There's our annual GDP, 2.6 trillion. Superannuation's now, what's that, 1.6 times bigger than our annual GDP, so we're very good at creating super, but residential housing is our biggest asset. Well done us. So I think the asset size of Australia is about $18 trillion, of which 60% of it is residential property. Quite unique. And we just plough more money into that because it's tax-free, and it really is the second pillar of retirement, except none of us has worked out how to liquidate our property to put it into our retirement pension. We're hanging on there. We don't want to do it. But we are creating a massive bubble. You can see the lopsided creation of the Australian economy. Way too much assets in unproductive housing. Way too much capital deployed there. In terms of GDP growth, going back to the June quarter just released, you can see what's happening. Growth at 1.8% annualised is not very impressive. Australia's been normally runs 2.25% to 2.5%, so we're about a third below what our normal long-term run rate is. The great generator of growth has been the government sector. So that deficit, and you've heard about the 27% of GDP in terms of the budget, expenditure, it's going straight in. That's what's actually pushing Australia's growth. Without it, we'd have very, very poor growth, like circa 1% real. And that really would be less than population growth. So Australia's going to grow because we print people, we immigrate them. We don't print money, we print people. Bring them in, that helps us grow. Then the government throws over the top and overspends. Inflation has come down, but the question mark about whether it's bottomed or we're going to have a period of around 3%. Well, now all the benefits for electricity are out of the way, all those freebies. Although we've got another 3 hours coming. Yeah. It's likely that we've got inflation sitting around 3.25%. And I know Steve will talk about this, and Leo, what's that mean for the RBA? Well, who knows, but they're good at sitting on their hands. I mean, I'd love to have a job where I can sit on my hands all day and do nothing. So that's probably what the RBA is going to do for the next 6 months as it watches this inflation cycle play out. And the weakness in the Aussie dollar must be a real concern. Now, it weakened again last night. Don't want to go too short term, but there is absolutely no confidence in the Australian dollar, and the effect on imported inflation is significant. Okay, so it's very, very hard to cut interest rates if America stalls in particular, and we get a further downdraft in the Australian dollar and a kick up in imported inflation. That's not good news. So we've got a few issues for the RBA to think about before it cuts interest rates again. Real rates have now gone positive again after a sustained period after COVID where interest rates in Australia were well below inflation. That's your negative blue line. We're going positive again. But arguably, that's about right. So 3.6% cash to 3% inflation, it's pretty hard to justify right where we sit on an interest rate cut to bring that blue line back to zero. Why should it be zero? The economy is growing under its own weight, really through immigration. It's not booming. There's no need to stall it. But cutting interest rates, is that really going to help? It's only going to help the property market rather than anything else. Immigration, so I love this chart because after we had COVID and we stalled our immigration, the bureaucracy of Australia decided, well, look, we can do a catch-up rally. We can immigrate 1 million people in 2.5 years to make up for the immigrants we didn't have during COVID. I think that's the policy. I think that was the thought process. They looked at the chart and said, how do we get back to an average 250, 300,000? We have 3 years where we immigrate 500,000 people. Madness. Given that you've got a housing shortage, They didn't think about the skills shortages, as you can see. In terms of permanent skilled, the lowest number of immigrants is permanent skilled. I would have thought you'd sort of do a bit more there. I don't know, maybe I'm missing something. So we just went for students and unskilled and short-term visas and all that. So that's put a massive issue into the Australian economy. The positive is it's created the growth. Did a view last week. We talked about what the unemployment drop. There is growth going on in the Australian economy. You bring in 1 million people, they consume. They don't come here and just sit on their butts and do nothing. They come in, get a job, work hard, pay tax, pay GST, consume, and they create growth. That's been the growth engine for Australia, is that immigration rate. Population growth, similarly, it's all immigration. Our death rate's gone to about 200,000 per annum. Thank you, COVID, that's done very well for us. Birth rate, we've got to get that up. We're not having enough natural births. We're down to, I think, 1.7 or something. It's too low, and no one's asking why is the birth rate in Australia dropped? Why do we have to immigrate people to get our population growth? Because it's become a very expensive place to live. And if you look at the immigration, we are immigrating a lot of people to do low-paid services jobs. Now, it's a great place to come, Australia, but when you're in low-paid services job, it becomes an incredible problem for you to survive in the cost of Australian living. Okay, so here's the rapid decline when comparing wages to inflation. So the worker has not really seen a real wage increase when you take out the COVID years since 2018. So we've got no growth in real wages when you take that blip out since 2018. Since COVID, the cost of living is probably running at around 25%. So it's 25% more costly in terms of running a family than it was 2022, but wages are up by about 15%. So there's your 10% negative gap, and it's brought it back to that level of 2018 real wages. That has an effect on the economy. If people's real wages aren't going up, they can't consume at a greater rate than inflation. The economy has this stalling function. So there's your real consumption decline. Consistent with labour productivity, I said to you early on we had a productivity crisis, and this is the RBA, it's their own numbers, so I don't question it. Significant drop in labour productivity and therefore consumption. So consumption is driven by wages against inflation. But why would the private sector pay more for people who are less productive? So there's a rational marketplace reaction. If your productivity drops, your wages decline. That's not so in the government sector. I'll leave you with that thought. Productivity and wages seem to be totally disconnected, and there seems to be a thought process going on in the Commonwealth government in Canberra that you just pay more and secure their votes. But that's probably a bit rude. So it's a little bit more dramatic, this chart, but says the same thing, a dramatic decline in our productivity over the prior decade. Again, that's from the Australian Bureau of Statistics. So we are having a productivity crash. Meanwhile, house prices are galloping ahead. So this chart measures capacity to pay. We've had another stimulation to the housing market with the government 5% deposit and doing away with the insurance. No better way to push up prices than another 5 or 6%. And so all the benefits you've given to the next generation to buy a home will be taken away in price movements, which is great for us in this room. We just feel more wealthy. But what's the effect in Melbourne? You've all got to put barbed wire fence around your house, haven't you? Is that what you do? I don't know. Not a problem in Sydney. It seems to be a bigger problem down here. Being a bit sarcastic there, but creating an issue for the next generation in terms of their standard of living and their cost of living and can they have a family, you will get disruption to society. So all your crime issues have very much, I won't say it's caused by this, but that wouldn't help it. That would not help it. Now, what's happening in the banking sector? And I know Steve will talk a bit about this, and Leo, but there was certainly a significant change in the way that banks have been regulated by their there's central banks and the groups like APRA. There's been a requirement that banks take less risk, have more capital. So when you think about less risk, it's in the asset side. So you have your capital base and you gear up your capital base into your asset size funded by liabilities. But on the asset size, Australian banks, it's been well documented, have moved from being properly true commercial banks 15, 20 years ago, progressively become big building societies. So about 85% of their assets are housing loans, mortgages. So their desire to grow their assets in that what they would regard as lower risk lending, because it's secured by housing, has meant that there's less supply of potential credit to non-housing, so financing businesses, property development, construction, infrastructure, all those things required to get an economy going. So what happens is the marketplace finds another way, and we've developed this private debt, private credit market as a replacement for what the banks used to do. And is it a bubble or is it an opportunity? And I think Leo will talk about that. But we see it as an opportunity, that it is a viable asset class. It comes right into that fixed income or floating income vertical. And when you're thinking about allocating money, you've just got to get the right deals. And you've got to have the right management and the right processes for assessing credit. So you'll read all these alarmist stories in the newspapers about, private credit bubbles and blah, blah, blah. But there is good money to be made. Now, it's not lending for companies' working capital. It's lending against security of property. And what's become apparent in the last, certainly since COVID, is that investing in loans against property have performed better than investing in commercial property. Much better yields, shorter cycle, and actually more liquid because you get your money back in 18 months or 2 years. So I'll leave Leo to talk to you through that one.